see markets rally despite all of this?
Yeah, well, certainly some extraordinary TV over the weekend. So I think one of the things you're seeing this year, as you mentioned, is a bit of rotation away from 2 years of outperformance from the U.S. into markets, particularly Europe, that were extremely cheap, and where the situation is changing. So we think, fundamentally, obviously, Europe is getting ready to stand up for itself, and this sort of reflects a structural change, we think, within Europe, and that's driven some of the, we think, rotation away from the U.S. so far this year.
Is that rotation also going to go into China?
So I think China is a difficult one. So obviously we've got the NPC coming up. For us, we kind of have a structurally still negative view on China. If the issues there with property and real estate, et cetera, were easy to fix, they would have been fixed long ago. We think there is an opportunity in tech where obviously the tech is kind of back, and especially reflecting Jack Ma coming back. So we think there's a positive added bias there. Also, those companies are extremely strong after the restructuring they've done over the last couple of years. But for China overall, we're still a bit negative. I think we also have to remember that there is a possibility that Trump tries to do a grand deal with China, and I think that's kind of maybe the dark horse scenario.
Karen, I wanted to get your sort of a bit more expansion on your views on Europe, right? This is our question of the day, which kind of asks how much further we could see the advancement of European stocks versus the US. And, really, so far they've really left their US counterparts in the dust this year, right? The Euro Stoxx 50 about 12% year to date, outpacing that 1.2% gain for the S&P 500. So do you think there's further sort of fundamental drivers in this rally? And is it more to do with the recovery in Europe, or is it more to do with this idea of sort of perhaps fading US exceptionalism because of the policy uncertainty?
Well, I mean, so we think it's a bit of both. So if you look at, so first of all, Europe was starting from extremely cheap valuation, especially relative to the U.S., so that's kind of the starting point. If you look at the sectors that have led, it's been banks and insurance. So banks, European banks have, valuation-wise, pushed past the post-GFC highs. So we're now pushing towards 1.1 times price to book for European banks.